Okay, guys, welcome to tonight's session. Tonight we'll be covering the subject MAC, and we will cover what are we going to cover? We're going to cover a cost of capital, a weighted average cost of capital question. I have chosen that one of the questions you guys provided me with, and what's the name now again? The name is Mambo. So there are two big questions in there, the WACC question, as well as the cost of the capital budgeting question. So in this lesson, the first MAC lesson, we will cover the cost of capital, weighted average cost of capital. And then in the next MAC lesson, we'll do the other part B, which is capital budgeting. So what I'll give you so the structure of today's lesson will be a high level overview of cost of capital, how to think through it. We'll spend just about 30 minutes. I'm going to go quickly through it just to give you a big picture, and then we will drill down into the detail as we work through the question. Okay. So let's begin. When we come to, in MAC, so it's basically management, accounting, and finance, what we will do over there, there's two parts, there's two areas, basically, two broad areas. There is financial management, and then there is cost accounting, okay, or management accounting. So we are focusing, this lesson is on financial management, which is dealing with the financing decision and the investment decision. So cost of capital helps you with decision making. So there's basically a few things you need to be able to answer. What is capital budgeting? Oh, sorry, not capital budgeting. What is cost of capital and why is it important? So we'll go quickly through those two aspects, and then we will deal with the how to calculate cost of capital. So what is cost of capital? Cost of capital is basically the cost of finance, or the general cost of finance for a business. The cost of finance is made up of two things, debt and equity. If you go back to accounting and you remember the accounting equation says assets equals equity plus liabilities. The assets portion refers to the investments, and equity and liabilities refers to how the assets are financed. Now, in financial management, that's exactly that. Equity and liabilities are your sources of finance to fund your assets. Now, you get two types of sources of finance. You have long-term sources of finance, and you have short-term sources of finance. When we're looking at cost of capital, when we're looking at the weighted average cost of capital, we are only interested in the long-term sources of finance. So take note, cost of capital, what is it? It is the general cost of finance for a business, okay? So if they want to make a long-term investment, if the cost of finance, if the general cost of finance for the business is, let's say, 15%, then when they want to make a long-term investment, the long-term investment should generate a return of at least 15%. Because if it generates a return of at least 15%, it will cover the cost of the finance. If it makes less than 15%, that means we are losing money because the return on the investment is less than what it cost us to make the investment. Similarly, if the return of the investment is more than the cost of finance, if it's more than 15%, then we are creating money, we are creating value for the business. So what is the cost of finance? It is the general, sorry, what is cost of capital? It's the general cost of finance for a business. And what's important to take note, it is your long-term sources of finance. And remember, your source of finance is equity and debt. So when we look at cost of capital, equity, all equity is long-term, but not all liabilities are long-term. So when we look at cost of capital, we said we only focused on long-term sources of finance. So that is all equity and then long-term interest-bearing liabilities or long-term interest-bearing debt. Okay, so that is cost of capital. Now, the next question is, why is cost of capital so important? Cost of capital is mainly used for decision making. Okay, so it's a rate used to help management make decisions. What type of decisions? Like we just explained a few moments ago, if they want to invest into a project, they should invest in a project that generates a return at least equal to the cost of finance. If a project does not generate a return at least equal to the cost of finance, then they should not go ahead with the project. So that is helping them with decision making in long term investments. Next, in financial reporting, we also use the cost of finance in financial reporting. I saw it is one of your topics, IAS 36. In IAS 36, impairment, when you perform an impairment analysis or an impairment test, the impairment test says the following, that an asset should be recognized at the lower of the carrying value and recoverable amount. Now we know how to get carrying value, but how do you get the recoverable amount? The recoverable amount is one of two numbers. It is the higher of the value in use and the fair value less cost to sell. Now, to get the value in use, there's some form of valuation you perform. And that valuation, the discount rate you use to discount future cash flows, is generally the cost of capital. So, as you can see, we use it also in financial reporting. WACC is also used when you do valuations. I don't recall seeing valuations on your list, but when we come to valuations or when you do come across valuations, this cost of capital number or this cost of capital rate or percentage will be used in the valuation calculation. So as you can see, that cost of capital number is an important percentage, is an important number because it helps you make decisions. Okay, so that's what we cover, two things. What is cost of capital and why is it important? Now we go on to where all the marks lie, and that is, how do you calculate cost of capital? Now, to calculate cost of capital, we need three things. We need to identify the sources of finance. Remember, we said cost of capital refers to your source of finance, but which sources of finance? It is your long-term sources of finance. What are your long-term sources of finance? It is equity, it is all equity, and then all long-term interest-bearing debt. Now, we will have to identify the specific equity instruments, and we will have to identify the specific long-term interest-bearing debt. So examples are ordinary share capital, preference share capital, debentures, bonds, long-term loans. Those are the typical examples. So remember, we need three things. The first thing is you need to identify your sources of finance. The second thing you need to identify or calculate or determine is the cost of each of those sources of finance. So let's say we have ordinary share capital, we have preference share capital, and we have long-term loans. Then we need to calculate the cost of finance for each of those sources of finance. So that's the second thing. The third thing that we need to determine the weighting of each of the sources of finance. So the three things we need to calculate the cost of capital is to identify the sources of finance. It is to determine the cost of each source of finance. And then number three, we need to determine the weighting of each source of finance. Now, the way you get the weighting is one of two ways. The weighting, they will either give it to you or you will have to calculate it. The weighting we are looking to use is the target capital structure. Another term they use is the optimal capital structure. So what is the target capital structure? What is the optimal capital structure? That is just basically the ideal, the best combination of the sources of finance. Okay, so that is all the weighting is all about. What percentage of the total source of finance is ordinary share capital, is preference share capital, is long-term loans, is debentures. Now, the target capital structure, that refers to the ideal, the best combination. It is the combination of finance that will cause the cost of capital to be the cheapest or to be the lowest. Now, in most cases, they're not going to give you the target capital structure because it takes away from all the calculations. Because there's a lots of calculations available if they don't give you the target capital structure. So if they don't give you the target capital structure, how do we get the capital structure? If they don't give the target capital structure, how do we get the weighting? So if you're not given, you have to calculate it. And the way we calculate it, we calculate the market value of every source of finance. So by determining the market value of every source of finance, that is how we'll be able to calculate the weighting. So let's go back. When you want to calculate WACC, you need three things. You need to identify the source of finance. You need to determine the cost of each source of finance. And then you need to determine the weighting of each source of finance. How do you usually get the weighting? By calculating the market values. Okay, so that's important to take note. Now we get into the nitty gritty. I'm going to go very quickly over it because we'll cover it as we go through the scenario and we'll repeat it. We'll do it repeatedly. And you can also watch the video again as we go through it. In order to calculate the market value, of ordinary share capital, there are two methods. We have the market capitalization method and we have the dividend growth method. Okay, so there are two methods available to calculate the market value of ordinary share capital. Market capitalization and dividend growth model. I'll give you the formulas as we go along. Okay. The question is going to be, how do you know which one to use? They're not going to tell you. Most likely, they won't tell you which one to use. You must be able to read the scenario and be able to pick up which method is the most appropriate. So the question would be, how do you do that? So one of the best ways to do it is when you come across cost of capital, you must tell yourself, okay, in order to calculate cost of capital, I need three things. I need to identify the source of finance. I need to determine the cost of finance of each cost of finance, and I need to calculate the market values. So one of the source of finance is ordinary share capital. In order to calculate the market value of ordinary share capital, there are two possible ways. There's multiple ways, but for WACC, for cost of capital, they're limited to two. There are two possible ways. One, market capitalization, and two, dividend growth model. Now, the question is, you will need to know what is market capitalization. The formula, I'm just going to speak it out now. We will, as we do the question, I'll write it out for you on Excel. Market capitalization is calculated as follows. Market value equals number of shares in issue times share price. So when you see information regarding the share price, regarding the number of shares, then you must know, okay, it is leading me to use the market capitalization method. The dividend growth model, the formula goes as follows. Market value equals dividends of the next period or dividends of the next year divided by the cost of equity minus the growth rate. Okay, so that is the formula. I'll put it into Excel. So I'm just going to run through it just to give you a high level idea. So that means When you see information regarding that, it will lead you to use the dividend growth model. So that is how do you calculate the market value of ordinary share capital. When it comes to the cost of finance for ordinary share capital, there are three methods available. Okay. Once again, they're hardly ever going to tell you which method to use. They're going to expect you to pick up which method is the appropriate method. So, what are the three methods? Number one, dividend growth model. So, the same formula you use in the market value, you can use to calculate cost of equity or cost of finance for ordinary share capital. The second method is known as the capital asset pricing model, CAPM. And then the third method, hardly ever used because it's too easy, but it's used more often than not in the real world. This method, I'm going to tell you now, this is the most common method used in the real world, and that is known as the bond yield plus risk premium. So for the dividend growth model, how do you calculate cost of finance? You just rearrange the formula of the other that we discussed under the market value section. So the formula goes as follows. Cost of equity equals dividends of next period divided by the current share price plus the growth rate. So that is the formula. For CAPM, it goes as follows. Cost of equity equals the risk-free rate plus beta multiplied by the market rate minus the risk-free rate. Don't worry too much. As you do the question, I'll put it into Excel. I just want to give you a big picture overview. Then the bond yield plus risk premium goes as follows. Cost of equity equals bond yield or the yield to maturity plus a risk premium. So that is the formula. So that is the most complicated part of WACC, of cost of capital, to determine the cost of finance and to determine the market value for ordinary share capital. Ordinary share capital is the complicated one. The rest, which is preference shares and bonds and debentures. So bonds and debentures is debt, and preference shares, that's the easy one. Okay. So preference shares and debt is determined in the exact same manner. So we have one heading when we explain it, preference shares and debt. Once again, for preference shares as well as for debt, you need to determine the cost of finance and you need to determine the market value. But the thinking process works as follows. You need to ask yourself, is the preference share, is the debt instrument, is it redeemable or not redeemable? Is it redeemable or non-redeemable? An instrument is redeemable if there is a specified date of repayment, if you have to pay it back at a specific date. So they tell you in 5 years' time you must pay it back. That means it is redeemable because there is a specified date of repayment. If there is no specified date of repayment, then you can only assume that it is non-redeemable. It's going to go on forever and ever. So that is very important. So the first question you need to ask yourself, is it a redeemable instrument or is it a non-redeemable instrument? Non-redeemable means there is no specific date of repayment. So then, which formula do you use? You use the perpetuity formula to calculate the market value or to calculate the cost of finance. If it is redeemable, if there is a specified date of repayment, then we will use our financial calculator. I'll show you how to use a financial calculator or we'll show it on Excel. I'm not sure if you guys physically write out or you guys write online. If you write online, you can do it exactly how I do it on Excel. If you don't write online, if you must go in or you write on paper and you scan it in, I don't know how your exams work, then you must know how to use your financial calculator. So that is basically a high level overview of WACC. So where you're gonna really put it in, the way you're really going to make sure you know how to do it is when we do some questions. So now we're gonna jump into a question, and then as we do the question, I'll bring back what I was the high level overview that I just explained now. I'll bring it back and we will go through and we will revisit and reiterate whatever I said so you can see it in action. But before we move on, do you guys have any questions? Any questions? Nothing?
I think myself, I'm good.
Okay. Okay. So um, if you can open up that what was a Mambo question, and I'm gonna. Do you have a question? Or something? How do you pronounce your name?
Yes, sorry to interrupt. May you kindly repeat on the types of the methods for calculating the cost of capital? My
For
network was
which one? For ordinary share capital. For which one?
yes, you were talking about CAPM.
Okay. Yeah.
When we were talking about
Yes.
the CAPM, we had other methods.
So to calculate the cost of finance for ordinary share capital, you have three methods: CAPM, dividend growth model, and bond yield plus risk premium. Those are the three methods. But what I'm going to do as we go through the question, I'm going to show you in Excel how to think through it and what are the three models, and also I'll give you the formulas. So we're going to go on to the question now, and then you're going to see when we start answering the question, I'll show you the three methods available, and then which one we will use in the particular question. Okay. So if you guys can just open up the
Okay,
Mambo
thank
question
you.
that you guys sent to me. Um, let's see. We're not going to read the entire scenario because we're going to be here forever. Um, so if you go to the Mambo question, I'll tell you which parts I want you to read. Okay. So what I want you to read, we need to have a background on the question. So if you can read the first page of the question up until I'll tell you where. Yeah. So read the first page and the second page, but up until the heading, the motel. Then stop there. Once you're done reading that, I want you to read on page 4. You just read capital funding. Okay, so you just read 2020.
I can't hear fast.
Sorry,
I
looks like
think it's your side. I can.
yeah.
What about that?
Okay, so yeah, I'm back. Um, the so what I wanted you to do, so I needed to read Mambo. We're not going to read the full question. All I needed to read is the first page and the second page. But on the second page, just read up until motel. So it's the first part. That's just to give us a background of the question of the company. It's important to have a background of the company so you can make sense. So the first page and on the second page up until the heading motel. Okay. Then then you go on to page, I think it's page 3 or page 4, where you read capital funding. It is 20, 21, 22. Okay, so then just read the points under capital funding, because that's going to help us. The capital funding is going to help us to answer part A. So I'm going to give you 10 minutes to read, and then I'm gonna read through it with you. We're gonna, Jens, I don't know if you plus probably know here in South Africa we have load shedding. So this week is load shedding. So yeah, in my area, load shedding is going to take place at 8 o'clock. So we will be done before 8. Okay, so I'm going to give you till 7 just to read quickly on your own. Then I'll read it with you, and then we will tackle it together. Okay.
All right, thank you. Everyone has the question, right? Just trying to see if we are looking at the same thing so that we don't have delays.
Okay, so I'll share mine with you
I
quickly.
don't know.
So here is the question. So just read the first page. So I need you to read on your own first before I read it with you. Okay, so let's start reading. So I'm going to read, as I made mention, I'm just going to read so we get the big picture overview of the scenario, and then we're going to read into the specifics. But I'm only going to read the specifics relating to cost of capital, so under the heading called capital funding, and then we will work through the question. So they say Mambo Limited is a diversified agro-industrial concern wholly owned by the Nayati family. The business interests of Mambo span a variety of crops, including potatoes, tomatoes, peas, peanuts, maize, soya beans, and it has poultry and beef cattle. Mambo has started by an Mambo was started by an enthusiastic housewife, Geraldine Nayati, 15 years ago in a backyard, first as a way to provide fresh vegetables for her family. By practicing good agronomic practices, she then realized she was producing more than her close and extended families could consume. She then began selling to supermarkets and green grocers in her neighborhood. Demand for her produce began to outweigh supply due to the limited land in a backyard measuring 1 acre. With the aid of a bank loan, um, the Nayati family acquired their first farm, which is just 25 kilometers from the family home in Westgate. Okay, so that's just some background. It's nice to have a background of the company. The farm, the first farm was called um, Evo, and Evo measures 80 hectares, 85% of which is arable. I have no idea what that is. In a bid to maximize land usage of the farmland on Evo, Geraldine decided to diversify into poultry. Her major breakthrough was her major breakthrough was when she managed to secure a farming contract with Evelyn Ltd, a listed poultry business. At this point, Member was formally registered as a company. Under the contract, Evelyn provides Evo with the day-old chicks, feed, transport for the day-old chicks, feed and collection of birds for slaughter, vaccines, medication, and cleaning chemicals as required, while the grower provides the infrastructure, labor, litter, brooding requirements, and water for the birds. The birds are kept at Evu's site and upon achieving target slaughter weight are collected by Evelyn. Mambo keeps 30,000 birds at Evu, with each bird at the target slaughter weight being paid $1. A 9-week cycle is used where the Mambo keeps the birds for 30, what is that? For 38, 40 days, and the site and the site rests for 3 weeks, during which cleaning and disinfection is carried out. Member now has a total of 3 farms and is now considering adding other main lines of crops such as tobacco and maize to their crops. On each on each on each of farms, okay? On each of the farms, 30,000 birds are kept under the Evelyn contract. Okay, so you may just now take some note. You can understand that there's quite a bit happening in this paragraph. Not the best worded, but okay. So number one, they have a crop that is measuring 80 hectares. Of the 80 hectares, what you know is edible. Do you know what that is? I don't know what that is. 85% of which is edible. We can Google and see what that means. So that means 15% is not edible. I don't know what that means. Um, you also understand that they were mainly into crops and they wanted to diversify into poultry. The way they diversified into poultry was to negotiate some kind of arrangement partnership with a poultry company. So the listed poultry company does some aspects of the whole poultry arrangement, and Ivu does certain aspects. Okay, it is good to take some time while you're studying and not necessarily in the exam, but while you're studying, just to picture what is actually taking place. As opposed, that is a way you're going to start to understand accounting and finance and so forth, is to just try to picture what is taking place from a business, ignoring accounting, ignoring finance, ignoring MAC, ignoring tax, ignoring auditing, ignoring that. Just picture what is happening from a day to day business perspective given the scenario. Now that you can picture what is actually taking place, if you can have a vivid picture in your mind, now you start bringing in the complications of financial management, of management accounting, of tax, of auditing, because that is are going to start improving your understanding when you are applying. But if you're just going to read a scenario and all you're focused on is accounting, or Mac, you're going to miss the bigger picture of actually learning. It's not easy. I'm telling you, it's not easy, but that is going to help you to grow in your understanding. So, like we are trying to understand what is actually taking place. So, we understand now that they diversified from crops into other items such as poultry. Okay, then they give you a whole way. They're giving you they outline a complete process of how the poultry is managed. Okay, so you can see there's a 9 week cycle, and so you can understand there's a 9 week cycle. 7 times 9 is how much? 7 times 9 is how much? That's 63. Okay, but there's a 9 week cycle where you can see the birds are kept for about 30 to 38 to 40 days, and the sighting rests for 3 weeks. Okay, so you can see whether that adds up to 9 weeks. And then the process restarts again. Okay, so just try to picture what is taking place even if it has no impact on the accounting treatment, even if it has no impact on tax. Because remember, a business is not all about accounting, tax, auditing, and finance. There's a whole lot of other stuff going in. So as a CA, like here in South Africa, cycle wants a CA to be of value to a business as a whole, and not just think in silos of accounting, of finance, of tax, of auditing, but rather to have a business mind. And the way you're going to have a business mind is to actually understand how businesses operate. And then you can provide your insights as a specialist accountant. So don't take the scenarios lightly. Try to understand what is actually happening. So let's go on to the next paragraph. They say Mambo has its head office in Westgate and employs a total of 25 head office staff and 45 full-time farm workers. Since the government has been pushing value addition of products, Mambo has been selling dried and tinned vegetables to the local market. This has enabled the entity to realize good returns as opposed to just selling produce straight from the field. As a way to diversify from the farming business, Mambo has been considering various other business ventures, such as starting a boarding school, building garden flats for sale, among others. The venture that has really stood out is purchasing a motel 10 kilometers from the national park. Okay, so now you can see they want to start making long-term investments. Now they're slowly contextualizing the strategic objectives of the company and moving it closely to financial management. Because when you can see they want to make long-term investments, you can start to understand that they're going to start bringing in capital budgeting now. So capital budgeting is to help you to make a long-term investment decision. So they say the motel has 25 guest rooms, which comprise of 40 single rooms, 40% single rooms, 48% double rooms, with the remainder being deluxe rooms. Given the government's drive to market Zimbabwe as an African poster boy tourist destination, Mambo believes this is a way to go. The tourism sector has been growing from strength to strength over the past couple of years, given the country's image being on the mend as a tourist destination of choice. The Nayati family has visited the motel and are excited about the idea. However, they are now awaiting approval of Mambo's board since they understand that it is a business decision and due process should be followed. The finance department has been asked to evaluate the decisions financially and make appropriate recommendations. So here they're coming into capital budgeting and so forth. The following information has been provided as a basis to calculate whether the motel would be a value adding venture to Mambo in the medium to long term. If the board is happy, then the purchase will be finalized on 1 April 2018. Okay, so that is now you have a background of the company, of what the scenario is all about. So when we do calculations, we actually can contextualize what we are actually doing. Because many a times, if you're in a finance department, if you're not trying to understand the business, you'll be doing financial statements and so forth without understanding anything. Whereas if you try and you put in effort to understand what is actually happening within the business, when you start putting financial statements together, when you record transactions, things start to make sense and you can add more value as a finance professional as opposed to just producing numbers. Okay, so try to start thinking in that way, especially that you are doing, you guys are becoming CAs. Okay, so we're not going to worry the motel upfront costs. That's going to impact capital budgeting. Motel revenue, that's going to impact capital budgeting. Cost and gross profit, that's going to impact capital budgeting. Other important information, I'm assuming that's also capital budgeting. Here we're going to come under capital funding. Okay, so under capital funding, remember, cost of capital, the weighted average cost of capital is your source of finance. Capital funding is your long-term sources of finance, and that is what we are interested in. We'll come back now to capital funding. There you can see there's a peanut butter factory. We don't know what that is all about. Okay, there's some other aspects over there. Okay, so we're going to do part A. Part A says calculate the weighted average cost of capital for Mambo. That is generally going to be the question when it comes to cost of capital. Calculate the weighted average cost of capital. So let's have a look at the capital funding section. So it says Mambo has an overdraft of $15,760 with Capital Bank. The overdraft is considered to be long-term source of capital by the entity. The overdraft balance averages 14,000. Mambo pays an interest of 12% on the overdraft facility. Okay, so what you have to understand, if any source of finance funds short-term items or is part of your working capital or your operations, when you see something is short-term or part of the operations or part of working capital, then it is not long-term source of finance. So a bank overdraft is generally used for short-term financing. It is generally used for working capital. It is generally used for operations. So therefore, it is not part of the long-term source of finance, and therefore it is not part of your weighted average cost of capital. But here, they specifically told us that it forms part of our long-term source of funding. So therefore, we're going to include it in our capital, in our WACC calculation. So take note, as you read your capital funding, there's three things you want to identify. The source of finance, which could either be debt or equity, the cost of finance, and then also your weighting. Okay, generally the weighting is going to be based on the market rate. So here we can see a bank overdraft and then the interest that we are paying. It's very important to distinguish between the interest you are paying and the market related interest rate. Okay, So they never told us what is the market-related interest rate. If they give you no other information, then you can only assume that that interest rate of 12% that you are paying is also the market rate. Okay. The share capital of Mambo is $450,000. So that is the share capital. Um, 90-day government bonds are paid an interest rate of 6%, while the 180-day bonds are being paid an interest rate of 9%. A 4-year rate of 8% is paid, and the 10-year rate is 5%. What they're giving you over here, I'll show you now that the formula for CAPM is as follows. The cost of equity, so remember to when we look, we want three things when it comes to WACC. We want to identify the source of funding. In number 21, the source of funding is ordinary share capital. The other two things we need is the cost of finance and the market rate of finance. Okay. Now remember, with the cost of finance for ordinary share capital, there are three methods: the dividend growth model, the CAPM model, and the bond yield plus risk premium. Now the formula for the CAPM model goes as follows. Cost of equity equals the risk-free rate plus beta multiplied by the market rate minus the risk-free rate. Now, the risk-free rate is typically your government bond. So the risk-free rate is typically your government bond. If you can see, they have given us government bonds and they are giving us beta, giving us quite a bit of information. Okay. Now, they're giving us different types of government bonds. You always choose the government bonds that is the longest period. So, the longest period one they gave us is the 10-year government bond. So that is the one we will use. Okay. So they're giving us government bonds. Here they're giving us the market risk premium is 7%. Very important to distinguish market rate from the market risk premium. I'll show you that now in the formula. Then they're saying the beta of FSUN Ltd, an entity listed on the Zimbabwe Stock Exchange, is 1.4. FSUN owns 3 motels and 6 hotels. The management of FSUN comprises of well-experienced and qualified individuals. They have been able to grow the entity of the listed entity that it is today. FSUN is part of a well-coordinated hospitality network that does part of its international advertising and referring international clients. FSUN's hotel face a high staff turnover than the industry average. Okay, I'm not sure what they want us to do with that, but they're giving us a beta. They're not giving you a beta of Mambo, they're giving you a beta of someone else. So I'm assuming we have to make some adjustment, but for this question, we're not going to make the adjustment. I'm assuming you have to make an adjustment, but for this question, just to illustrate the principle, we're not going to make an adjustment. Okay, but I'll come to that just now. The last one, Mambo has permitted to issue debentures. Mambo was permitted to issue debentures which were fully subscribed by a private company. Mambo was permitted to issue debentures which were fully subscribed by a private company. I'm assuming it says that assists indigenous Zimbabwean companies. The coupon rate for the debentures was 8.5%. The $100 bonds will be redeemed in 5 years' time at a premium of 5%. So there you can see there is a specific date of repayment in 5 years' time. So therefore, it is a redeemable debt instrument. It's a redeemable debenture. So what we will do, we will calculate we will use the financial calculator to calculate the rates. In fact, at the premium 5%, 300,000 was raised from the issue. Agent fees of 1% of the debentures were paid by Mambo to facilitate the company. Okay, so let's have a look over here. Do you guys have a solution for this question? Because some information, they're not giving every information over here. We can't calculate everything. Do you guys have a solution? Anyone? I'm gonna open Excel in the meantime. So I want to just see how they get some of the answers. Some information we can't calculate. Justin, Tauri, anyone? Do you know if you have a solution?
Yes, I'll look
Okay.
for it. There's
Yeah,
information that we didn't read there.
okay, you don't have to do it now. You can see it tomorrow, but we won't be able to answer the entire question because just reading, I can already see information is missing. But we're still going to go through the thinking process and then we'll answer as far as we can. Okay. I'm now going to
Yeah,
share.
I think I got the solution.
Can you
How
send it via WhatsApp?
should I share this?
You can send it via WhatsApp. I'll check via
All
WhatsApp.
right, that's okay.
Um,
All right.
you should be able to see my Excel now. Can you see it?
Yes.
Okay. There is see as well as see. What did I do? Oh, okay. What's the tax rate in Zimbabwe? 20, what? 20? 25.75%.
Yes, 25.75. I think by the time they were doing the this question, but it has since changed. But I think this one should be 25.75.
Okay. Okay. Okay, so when you come to WACC, when they say, dear student, please calculate the weighted average cost of capital. Whenever they tell you that, dear student, please calculate the weighted average cost of capital, the first thing you do is write down the WACC formula. Okay? The first thing you do is write down the WACC formula. So what is the WACC formula? Weighted average cost of capital, WACC, equals cost of equity multiplied by the value of equity divided by the value of equity plus the value of debt. Plus cost of debt. I'm assuming, I think I saw it. Cost of debt multiplied by 1 minus t, meaning after tax rate, multiplied by the value of debt divided by the value of equity plus the value of debt. Now, this may look daunting, but let's break it down. Remember what I told you. You need three things to calculate WACC. You need three things to determine WACC. Number one, you need to determine your sources of finance. So if you look at the formula, this is equity, this is debt. Okay, so that is number one, identifying our sources of finance, equity and debt. Obviously, when we do the actual calculation, we split out the specific equity and we split out the specific debt. But in general, we're not going to write a separate formula for every debt and every equity. So in general, we're just saying equity plus debt. That's number one. The second thing we want is the market rate or the cost of finance. KE is the cost of equity. That's the cost of finance relating to equity. KD is cost of debt. That is the cost of finance relating to debt instruments. By debt, we say 1 minus T. We take an after-tax rate when it comes to debt, but there's no after-tax rate when it comes to cost of equity. Why? The cost relating to cost of equity is dividends. So dividends declared and paid. The cost relating to the cost relating to cost of debt is interest expense. Now, in most parts of the world, and it appears in Zimbabwe as well, that the tax authorities do not allow a tax deduction for dividends paid, but they do allow for a tax deduction for interest paid. So therefore, there is a tax benefit when there is an interest cost. So therefore, we need to take that benefit into account by saying the cost of finance is not 100%. The cost of finance for debt is 100% less the tax savings. The third thing we need in the WACC calculation is the weighting. Now remember, we said the weighting is the percentage of each source of finance over the total source of finance. So here you can see value of equity plus the value of debt. That represents the total long-term sources of finance. That represents your capital structure. Your capital structure is your long-term sources of finance. So by you saying the value of equity divided by your total long-term source of finance, you are saying what percentage of my long-term sources of finance is funded through equity. Similarly over here, if you look at this over here, once again, we have value of equity divided by value of debt. It's the same thing as that over there. It is your long-term source of finance. It is the value of your long-term source of finance. It is your capital structure. So by you saying value of debt divided by your long-term source of finance, you are saying what percentage of my long-term source of finance is funded through debt. So if you can see that, you would appreciate that that formula looks complicated, but we break it down into the three things that we need, then you would realize that the formula is not actually complicated, it's just a lot of letters, okay? So that's the first thing you'd like to write down. I'm not sure if that's part in your solution, we will see. The second thing you want to do is set up the WACC table. So the WACC table looks as follows. Sources of finance, column 1. Remember, your source of finance is debt and long-term interest. Sorry, your source of finance is all equity and long-term interest-bearing debt. But we can't just say in equity and long-term interest-bearing debt. We need to specify the type of equity and we need to specify the types of long-term interest-bearing debt. The second thing you want to have is your market rate or your cost of finance, whichever one you want to call it. Market rate, and make it clear to yourself that it must be a market rate after tax. But remember, the only after-tax amount will be your debt, because there's no tax implications when it comes to the cost of finance relating to equity. The third thing we need is a weighting. But remember, if the weighting is not given, we need to calculate our weighting. The way we calculate our weighting is by determining the market value. So once you have your market value, you can get your weighting. And once you have your weighting, you can actually get WACC. So how I like to do it, so the way I like to do it, I say that the market rate is A, my weighting is B, so WACC is C equals A times B. Okay, so that is, so the first thing you do, when you say, dear student, please calculate WACC, write down the formula. The second thing you do is set up this table. The third thing you do, the third thing you do is to identify your sources of finance. Now we already read there's ordinary share capital, ordinary share capital. There is, what do we see? Bank overdraft. And then there is, what was the other one? Debentures. Okay, let's just see if there's anything else. I was going to check quickly if there's anything else. Okay, I don't see anything else. Well, we never read the entire scenario, so we don't know. But just based on that, I don't think I saw anything else. Okay. Okay, we never read the entire scenario, so I'm just going to use the information under capital funding. Okay, so that is our sources of finance. Now we're going to have to calculate each of these. So this is going to give me WACC. Okay. Okay, so there we go. So that will determine WACC. Okay. So now let's have our workings. Try to have your workings below the actual answer. Have your answer first, the workings below the answer. So let's start with working 1. The first thing you want to do, you want to see what was given. Okay, so from market rate, so remember we want market rate, we want weighting. The weightings were not given. Therefore, in order to get the weightings, we're going to have to calculate market values. So basically what we are looking for are these two columns, the market rate and the market value. So we're looking for those two columns, the market rate and the market value. Okay, because the market value will be used to calculate the weighting. Now, before you just run into calculating a market and a market value, first ask yourself what was given. If it was not given, then you only calculate. So if we go back to the scenario, I'll come back to number 20. That one is easy. If you look at the scenario over here, they're telling you share capital of Mambo is 450. So I'm assuming that is the given answer. That I'm assuming that is the market value. Okay, so there, because there's no other information given in order to calculate the market value. So the only thing we can assume is that this 450 is given as the market value. So therefore, there's nothing to calculate for the market value. So I simply just go plug in 450. Okay, so I simply plug in 450. Now I look again at the scenario and I can see there's no cost of equity given. Therefore, I need to calculate the cost of equity. Now remember, to calculate the cost of equity, so when we want to have ordinary share capital, we have market rate and we have market value. Now the market rate, there are three methods. We have CAPM, we have we have dividend growth, and we have bond yield plus risk premium. Now for CAPM, market rate cost of equity equals the risk-free rate plus beta. Beta is actually a Greek or whatever. I think a Greek numerical. I don't have those kind of numbers or letters, so I'm just using B for beta. Okay, but remember, you can write B because they're not going to know what it is. You must write that symbol that represents beta, some Greek symbol, I think. My laptop doesn't have it. Then it is, so cost of equity equals risk-free rate, which is typically your government bonds, plus beta multiplied by market rate minus risk-free rate. Now, what's very important to understand, that RM, market rate, minus RF, risk-free rate, that represents your risk premium. So just take note, risk premium equals RM minus RF. So in this question, they never gave us the market rate. They never gave us RM. They never gave us RM. They never gave us the market rate. They gave us the risk premium. So what did they give us? They gave us this full bracket. It's very important. Don't make the mistake of assuming the risk premium is the market rate. Okay, so just understand that. Over here, the dividend growth model, cost of equity equals D1. D1s means the dividends of the next period divided by V0. That is the value, the share price today, plus the growth rate, plus G, which is the growth rate. Then the bond yield is basically yield to maturity or bond yield plus risk premium. Okay, the risk premium they will give you. So as you can see, you must know the formulas so you can identify what makes up each formula. By knowing what makes up each formula, that is how you will identify, given a scenario, what needs to be calculated. Okay, which method to use. So you saw they gave us government bonds. Government bonds refers to the risk-free rate. You saw they gave us beta of another company. Okay, and then they didn't give us a market rate, they gave us a risk premium, so they gave us this entire bracket. That tells you, dear student, please calculate cost of equity for ordinary share capital using the CAPM method. So they're indirectly telling you. When it comes to the market rate or the market value for ordinary share capital, there are two methods. Okay. The two methods, dividend growth, and the way market capitalization. Market capitalization, market value or value equals number of shares in issue multiplied by share price. Okay, the current share price. Over here, value equals D1, the dividend of the next period divided by cost of equity minus the growth rate. So remember, this and this is the exact same formula, just rearranged. Okay, so that is how, that's the methods available to calculating the market rate for ordinary share capital and the market value for ordinary share capital. So now we can go and actually calculate. So the market value was given. We now need to calculate the market rate. So given the information, the market rate will be determined by using a CAPA method, which is cost of equity equals risk-free rate plus beta multiplied by RM minus RF. Okay, so what we're going to say, we want cost of equity. So what do we need? We need RF, we need beta, and then we need, so we know we need RM, but in this case, it's RM minus RF. Okay, so what we're going to just say, risk premium given, the risk premium was given to us as 7%. This is government bonds. Government bonds using the longest period, therefore using the 10-year bond. Why do we use the longest period? They give you a 15-year or 20-year, you use the longest period. Because remember, we're calculating a cost relating to ordinary share capital. Ordinary share capital is there forever and ever. So therefore, you use the longest bond period. So given the information, the longest bond period was 10 years. So we use that government bond of 10 years. There wasn't a 15-year, there wasn't a 20-year government bond. The longest government bond was 10 years. So we use that rate. That rate was given to us as 5%. And now we must calculate beta. Now remember, they gave us beta of 1.4. However, we can't use the 1.4. The reason being is the reason being is that the reason being is that it relates to beta of another company. Okay, it relates to beta of another company. So we need to adjust that beta to represent ours. I just want to mention something over here. I see they're not using 5%, they're using a different percentage. What you must understand is that your weighted average cost of capital represents the cost of finance for the general company. It does not represent a specific investment. It represents the cost of finance for the company as a whole. That is what WACC refers to. So what they did here, actually, they calculating WACC not for company as a whole, they calculating WACC for the motels specifically, which they're not making it clear. When they ask you for WACC, is it generally calculating WACC for the company as a whole, not for a specific investment. Very, very important to understand. WACC is a general cost of finance, not a specific cost of finance. So technically, we should be using the longest government bond because of 10 years, because that represents, that is closest to equity, which is forever and ever. However, what they did here, they used the 4-year government bond. And they are saying, the reason why they are saying it, because the proposed investment, which is this motel, is for a 4-year period. Now, like I said, WACC is not specific to a particular investment. WACC is the general cost of finance. So I'm not sure how you're going to pick that up. Maybe must ask your lecturers for clarification and ask them that because WACC is the general cost of finance, why do they calculate WACC based on specific investment? So they are using a 4-year government bonds. I'm just going to put this on the side. If you had to calculate WACC using the general principles, you will use 5% because that represents the longest form of government bond, which is 5%. They have used 8%. They have used 8%, and they're saying they have used the 8% over here. We said 8%. They're saying a 4-year rate of 8% is paid, and then the 10-year rate is 5%. So they are using a 4-year rate because they're saying the motel is a 4-year period. Now, like I'm saying, WACC is not specific to a particular investment. WACC is the general cost of finance to a business, which is forever and ever. Okay. What you do, you work out a general cost of finance, and then you adjust the general WACC rate for every specific investment, because every specific investment may not represent the general business operations. So you must just be aware of that. So maybe you can just ask your lecturers if this is the way they will always do it, specific to investments, or are there going to be instances where it's just general to the company? Like I said, if you read any textbook, they're going to tell you that the WACC is a general cost of finance. That is one of the problems of WACC, that it represents a general cost and it does not represent a specific risk for a specific investment. It represents the general risk of the business. And that is why when you move into a specific investment, you adjust the general WACC rate. So you just need to find out that from your lecturers. But I'm going to use based on what the scenario, based on what the solution have 8%. So like I said, if I didn't have the solution, I would have used 5% because that you always use the government bond. That is the longest period, because the longest government bond, that is the closest to equity, which is for forever and ever. Okay, so just remember that. Here they're using 8%, which is the 4-year bond, and they're saying because the proposed project is 4 years. Maybe they have an argument, but that is not exactly how it gets done. So please take note of that. Now we're going to have beta. Now beta will have to be calculated. Okay, so we're going to have to calculate beta. We will start off with the beta of a company that is given, and then we will make adjustments to beta. What you must understand, there's no specific number that you will just make up what you want. Okay, so this is how we'll do it. So to calculate beta, we will start off with comparable company. The comparable company is that company that gave us where the beta was, we just see. So the comparable company is FSUN, which and they're giving you a beta of 1.4. Okay, so they're giving us a beta of 1.4. So we start off with 1.4. We can't use 1.4. The reason being is it is a comparable company. It is not our company. We need a beta for our company. So what do? We adjust for differences between our company and the comparable company. Okay, so you can put in basically, you will look at the scenario and you put in different things. So one of the obvious things is Mambo, one of the obvious differences between Mambo and the comparable company is that Mambo is not listed. Not being listed is unfavorable. Okay, so not being listed is unfavorable. Not being listed is unfavorable. Unfavorable means it will increase the risk. Okay, so that means Mambo, so higher risk. So not being listed means Mambo is more riskier relative to the comparable company. Okay, so we're happy with that. Now we put in some more things. Mambo is not listed. That's the first thing. So here's Afsan owns 3 motels and 6 hotels. So this company have 3 motels and 6 hotels. How many motels and hotels does Mobile have? I mean Member have? Member only has, well, they're only attempting to have the first one. Member only have 1 motel. They don't even have 1 motel. They're only still getting 1 motel. So therefore, is it better having 1 motel or is it better having 3 motels and 6 hotels? Which one is better? So the other company is better. Therefore, from Mambo's perspective, Mambo is higher risk. Okay. Then, if we go some more into the scenario, the management of FSUN comprises well experienced and qualified individuals. Okay, so you can see my lights went off, but can you see still? Do you want to continue? You okay? Can you see? Hello, guys, can you hear me? Hello?